Good morning. Hope your weekend's off to a great start. Today, we're just going to kind of dig a little bit into some economic stuff. Look at the markets a little bit. Going to look at housing. Got some questions on housing. Housing is, for many people, the largest asset that they've got. So obviously, it's very important. And then we'll just finish up from there. Again, I always want to start off, I'm going to do this quite a bit, sort of my long-term thesis on the investment side. I think we're in a period here that we're going to have inflation. And I think it's going to last probably, like a decade long with periods where we have deflation. Now, why do I think we're going to have a longer period of inflation? Well, I've mentioned it before, underdevelopment in the commodity infrastructure. So whether it's not just oil, not just energy, but all kinds of commodities. And that's going to result in a big inflationary trend. Couple that with the green movement that's been going on. And I've talked about how I think the green movement is ridiculous in that they think solar and wind is going to be able to provide all the energy needs that we need at a price that people could afford. That's just not the case. And it actually is probably way less green than fossil fuels when you factor in everything it takes to develop and then dispose of those solar and wind panels. And then finally, globalization, I think, is no longer a tailwind that we've had for really the better part of 3 decades now. So we're going to start to see, because of tensions with China here in the U.S. and then Russia over with Europe, we're seeing some trends break that are going to be inflationary. So for us, we're going to be resourcing a lot of manufacturing. Doesn't necessarily mean it comes into the United States, although a lot of it will, but just probably South America, Canada, Central America, because of the conflict with China, and we don't want to have a 5,000 to 7,000 mile chain to travel to get our goods. We just don't want that. So we're going to start to see that come on, but that's inflationary because you have to build plants, you have to, train people, get people into these jobs. They'll be probably paid better than what the Chinese pay their citizens. So that's inflationary. But the Fed is hell-bent on bringing down the inflation that we're seeing right now. Now, everybody in the market all last year figured the Fed will fold at some point because the Fed has folded at any time the market struggled, dating back to 2009. So from this whole last bull market, anytime the market pulled back 10%, the Fed would step in and throw money at it. But see, back then the Fed had sub 2% inflation. Now we're talking anywhere from 7 to 10% inflation. It's a different ballgame. And the Fed, one of their mandates is to make sure that we have stable prices. So they're going to do what it takes to make sure that we don't have inflation, that it doesn't ravage the economy. So that's why I think in the shorter term, I think we're going to start to see deflation, mainly because they're pulling the punch bowl away. And that's going to be a deflationary effect. It's going to slow down inflation. But I don't think it's something that, as soon as they think they have deflation under control, they'll let off the gas pedal, and then it's probably going to rear its head once again. So what do you want in a deflationary environment? Top asset classes: cash, long-dated treasuries, although that didn't work out last year. You want vehicles that kind of short the market, whether it's long volatility or things that buy put options or go against the market. And then gold. Okay, so like I mentioned, the Fed is very hell-bent on reining in inflation. And this shows the black line is their balance sheet, and then the orange line is the S&P 500. So you can kind of see here when when the Fed is accommodative and they're printing money, putting money out there, the stock market does very well. But as they start to pull money away, as things start to slow down, the liquidity's pulled out, the market struggles. And if you look at the far right of this graph, you'll see that the Fed is now starting to pull back on their balance sheet. And it's amazing when you look at that black line, and we talked about this before, going back to the 1970s, the Fed had a balance sheet of about $800 billion, all of it in treasuries, and it stayed pretty consistent throughout. And then in 2008, they expanded their balance sheet massively to over $2 trillion within a year. And then it's been continuing on since then. And after COVID, you could see kind of that 2019, 2020, massive spike up in their balance sheet. I mean, absolutely ridiculously high. And now it's over $4 trillion. So as they pull that away, that has been the tailwind for all asset classes gaining in value. And if they pull that back, that's going to have a negative effect on asset prices. It just is. And this isn't even looking at the Fed's fund rate, the overnight rate that banks charge each other. That's the rate that the Fed controls. This is just looking at their balance sheet. So right now the Fed is not only raising rates, but they're also taking money off of their balance sheet. They're trying to reduce their balance sheet. So another big thing why I think we'll see some deflation, I've been saying that I really see kind of an inflationary period. A recessionary period. And the biggest reason, telltale, is bonds. We have the largest inverted yield curve since 1981, and it's even way bigger than it was in 2008 and then 2019, 2020 when COVID hit. Why is an inversion bad? Again, remember, when you loan money to somebody, you're going to ask for a higher interest rate if you're loaning it to them for 10 years as opposed to 3 months. And that's what this chart looks at. It's looking at treasuries that are 3 months compared to the 10-year treasury. And so right now you can get a higher interest rate on a 3-month treasury than you can a 10-year treasury. So it doesn't make a lot of sense. Why does it do that? Well, what the longer dated bonds are saying is they see deflation coming. And in this case, it's going to be probably a recession. That's sort of what they see. And I've talked about it before. A lot of times they look at the 2-year treasury and 10-year treasury. When that inverts, it typically means you're about 12 to 18 months away from a recession. But the 3-month, the 10-year treasury is pretty much an on-the-spot indicator. So it's saying we are in a recession. When they get inverted like this, it means you're there. You're in recession. So it's saying that we're in recession right now. And the thing is, a lot of people are thinking because of that, the Fed is going to pivot and become accommodative with monetary policy. They're going to lower their interest rate, stop reducing their balance sheet. But that doesn't necessarily bode well for the stock market, because the way that these inversions get corrected is the shorter end, the 3-month, will come down, 10-year might stay right where it is. So what it means is the Fed is going to eventually cave. They're going to see that things are getting really bad, so they lower their interest rate. So if you look at this chart again, go back over to where it says 2007, you'll see the inversion was pretty strong. By the time we got to the craziness of 2008, the inversion was no longer there. There was no longer a below zero inversion between a 3-month and 10-year. You had a normal curve where the 3-month was yielding less than the 10-year. It meant that things got so bad that the Fed became accommodative. So that's what they're hoping that will happen here. The Fed becomes accommodative, the good times roll. But the problem is every time the Fed has finally made a pivot in one of these situations where they start to lower their interest rates or become accommodative, the stock market gets slugged in the gut. So if you look in 2000, once the Fed really started to pivot, markets went down 51%. In '08, things went down 58%. The Fed pivot with COVID, when they finally changed and went to zero policy, market dropped 35%. So the pivot, all these people rooting for the Fed to bring rates down don't realize that probably means the worst is ahead for the stock market. And, the stock market has kind of had a decent start to the year, which is good. This, again, is a chart of the Vanguard total stock market. So this is large, mid-size, small company stocks. And we've shown this quite a few times. And what we have, that light green line, is the 200-day moving average. I use that quite a bit as an indicator for me. And what we've had throughout the year is it gets up. It might break the 200-day. We've had about 9 days over the past year where it's been above the 200-day. As soon as it gets above the 200-day, it fades back down. The other thing I've talked about is how what I've been looking at this chart is, for the most part, you're getting lower lows and lower highs. What does that mean? Again, every time the market heads south, it goes below the previous low. So you get a lower low. And then during these bear market rallies, it'll rally up, but it never gets above the previous high. It's a lower high. Well, we did have some pretty good movement. So if you look here, the market came back down. If you look at the far right, market where it started to come back down. And then in January, it started to come back up. So we had a fade basically late November into December. And then starting in January, we've had a move up. So the nice thing is that low, if we consider that a low, it is higher than the previous low. So that could mean that we are in a bull market. Now, the bad news with this chart is as soon as it hit the 200-day, this year, it's already faded back down. So it wasn't able to maintain that, benchmark right there. We'll see what happens. So you could make an argument, hey, maybe we're done. But it hasn't been able to get past a higher high. We'll see. It could. I don't know though. The thing that probably should alarm people with this recent move in the markets is it's been trash that's led the rally. So a lot of these companies here that have done very well since the start of the year are trash. I mean, there's no other way to put it. A lot of these are going to be gone by the end of the year. And I'm not saying that because I'm calling them trash, but if you look at the amount of cash that they have on hand, and you look at their monthly burn rate, so their negative cash flow each month, they don't have enough money to make it through the year. AMC, Bed Bath & Beyond, GameStop, a lot of these Pelotons, Robinhood, these companies, unless they can get access to new money, that could happen. It could carry it. But, I mean, who's going to loan to them when they're clearly just burning through whatever cash they've got. They're trying to get through this, but it's just not working. So when trash leads a rally, it kind of just shows me some speculations back. It also tells me people think the Fed's going to pivot, so we'll have money running. Now, one good sign is, I've been showing this chart for a while, is just how volatility from now compared to the 2007 and to 2009 market. So they were pretty strongly correlated, but recently, if you look at the white line, which is now, it's kind of broken the trend. So you don't necessarily have that same, not seeing it where it could start to explode and the markets go down. Maybe that's a good thing. So I keep looking at this. You can never really compare two periods. They're not going to be perfectly correlated. But it was fun to just sort of watch it and see if it kind of held or not. But there are some asset classes that are doing really well, very strong. Gold has started to reemerge once again, well above the 200-day. And as you look at this chart, I also have another calculation that I do looking at several moving averages. So when it's orange, you see that orange trend, that means you want to buy. You see the blue trend, that means you want to be out. So that plus the 200-day is kind of what drives my thinking. So gold's really big. Silver is also on the move. So metals are on the move. They're looking really good. Energy prices, unfortunately for us at the pump, are bad, but as far as an investment, they're doing quite well, showing a lot of strength. But yeah, the bad news is energy prices are coming back up. Oil is going back up. And if you really start to see some cold weather in Europe and here in the US, we'll probably see them go up substantially, especially natural gas. But some sectors are struggling a little bit. Staples. So we are in staples. It's a sector that does better during recessionary periods. So maybe this is saying that we are going to have a change in leadership, and that tech stocks and some of the more growth stocks are going to take over. Could be that. This is broken below 200-day. I didn't sell it. It's still in an orange uptrend, but we'll see next week when I look to trade if it might be something that we sell. So right now, it could be something that's going away. Healthcare has also struggled. It's still above the 200-day. It's still within a buy trend. So we'll hold for now, but we'll watch it. But it's another, safety sector that's now kind of struggling a little bit. So again, it could just mean the market's going to go back to sort of a growth model versus a value model. Or it just could be something temporary because a lot of money's been run into the trashy stocks. So what I'm always looking at economy-wise, bigger picture stuff is economic indicators. And there's really three kind of economic indicators. There's a leading economic indicator. So that sort of tells you what's coming down the pike. There's a coincident economic indicator, and it kind of tells you what's happening on the ground right now. And then there's a lagging economic indicator. The lagging indicators sort of tell you, those things are the things that tell the story after it's already happened. So it's sort of a history lesson. Leading economic indicators tell you, again, not where the puck is, but where the puck's going, as Wayne Gretzky used to say. So you look at things like capital goods orders. So if you see a slowdown in the amount of big manufacturing that countries and companies are putting in, that's not a good thing. Building permits are another thing to look at. Building permits, obviously there's a lot of jobs and economic activity associated with building homes. Work week hours is a big one. So how many hours are people actually working during the week? If the hourly employees are getting less hours, that's kind of telling you what's coming down the road. And then looking at things like the University of Michigan does a lot of surveys on consumers to see what their confidence is and what their purchasing plans are. So those are sort of leading indicators. And right now they're basically showing that they've been dropping for quite a while now for most of 22. But they're at a level at this point that is usually associated with recession. Coincident indicators, like I mentioned, what's happening on the ground right now. You're looking at payrolls, you're looking at real earnings, hourly earnings, manufacturing earnings, and then the gross domestic product. And it's not rolling over yet, but it's flatlining for sure. So we'll see which way it goes from here. But it's definitely not showing positive momentum, but it's not necessarily showing recession. And then the lagging indicators still look pretty good. And this is mostly going to be unemployment. Unemployment is, a lot of people look at that to see if we're in a recession or not. But the honest truth is, by the time unemployment spikes, we've pretty much gotten through the recession. Recession is over. So it's an indicator that tells the story too late. And it kind of makes sense if you think about it. If you own a business, the last thing you want to do is lay somebody off. You don't want to do that to anybody. Even people who think corporations are evil, there's people working in there. They don't want to lay somebody off. So it's like the last thing that you do. You get to the point where you just know you can't keep going the way it is, and you've got to lay somebody off. You struggle, you try to keep it going, but at some point you're like, I got to cut something. And people are always the biggest expense for most businesses. So once you start to see that spike, it pretty much tells you that we're through this. So what's really sort of alarming is if you take the leading indicators and you sort of divide it by the lagging indicators, this ratio is now at a point where it has always been a recession. So every time it's hit the level that it's hit now, we've either been in or we go into a recession. So it's not too good. Okay, so that's some economic stuff. I'm going to talk just real quick about home prices. Home prices are also sort of a lagging indicator. It's the last asset class that starts to see declines. And usually you see it in the stock market, bond market, all the other precious metals, commodities markets, all of that get hit before real estate does. And, right now it's just not looking good. On an inflation adjusted basis, homes are still more expensive than they were at the peak of the last housing bubble. And then if you look at the amount of the percentage of your household income going to a mortgage right now, it's higher than it was in 2006, and it's as high as it was going back to the early 1980s, late 1970s. So families are spending 45% of their income just to keep the house, just to keep the mortgage going. So a really healthy ratio is about 30%. If you could be under 30, that's even better. But this is high, and this isn't just because of the interest rate spike that we've seen recently. This has been going on for a while. It's home prices have just gone up so much. Even at lower rates, people were forced to buy just ridiculous. They paid ridiculous amounts for homes. And if you look at it, this is sort of taking the last graph and throwing it in a different way. It's the mortgage payment divided by the average hourly earnings. And you can kind of see from that, we're right back where we were in 2006 at the peak of the last housing bubble. And, the only time it's been higher is the 80s and late 70s when rates were ridiculously high. And this just shows affordability for homes is declining like a rock, and it's well below the 2006 period right now because of the interest rates going up. Mortgage rates are still, they've come down from their 7.1%. They're now about 6.2, but 6.2 is still pretty awfully expensive compared to where they were just a year and a half ago. And this chart just gives you an idea of what's the real impact. What's it look like? So if you have a family and they're in a home and they have another child, or get a new dog, or they so they want a new bedroom, they want another bathroom, what's it cost to upgrade? And that's what really drives the real estate market, is people always kind of upgrading to a bigger place. And so let's say right now you're in a house, it's $500,000. You got a couple $100,000 in equity, so your mortgage is $300,000, but you lock that in. Hopefully you're smart enough to lock that in when they were sub 3% rates. So you got a 2.75% mortgage rate. So your monthly payment was about $1,225 for principal and interest. Well, if you want to go up to even a $600,000 house, which isn't going to probably give you a whole lot more, you take that $200,000, you throw it in, you got a $400,000 mortgage at 6.3%. Your payment essentially doubled up to $2,484. Wow, that's huge. So you only get $100,000 more in house, but your payment has doubled. Now, if you really wanted to go big, let's say you're going to go to $1 million house, now you're looking at about a $4,967 per month payment as opposed to $1,225. So the upper end of market, the bigger homes, they're going to have some serious price pressure because there's just not as many people that can move up into those homes. So that's going to have an impact on real estate prices. And the biggest thing that you can, why I kind of think that there's going to be some problems with real estate is new construction leads existing home sales. So you want to look at what the builders are doing, because the builders are in a different spot. If you don't get the price you want on your home, if you're trying to sell, you can just stay where you're at. Hopefully. I mean, unless you have like a job across the country or something that's forcing you to move. But for the most part, you can just hang out where you're at and say, well, I'll just wait till I get the price I want. Builders can't do that. They don't want to have supply on their books. They don't want to become landlords for sure and rent things out. They want to move the property that they've got. And right now, the number of housing units under construction, this isn't even just newly built, this is under construction, it's about 1.7 million. So at the peak of 06, we were at about 1.4 million. So we have more houses coming onto the market than at any time previously. And again, these guys need to move these. And it's showing up in the supply. So, supply is low right now for homes in general. For existing homes in the black line, it's about 3.3 months of supply nationwide. But for new homes, for new construction, we're at about 8.6 months of supply. Again, these guys need to get rid of this supply. So remember, real estate is priced on the fringes. If 95% of people hold their homes and they don't sell, you think, well, the value will hold. But it's priced on those 5%. So if that 5% of homes are selling for substantially below your price that you think your home is worth, well, guess what? Your home price is coming down. So it's the sales, it's the fringe. So what you're probably going to see with new construction, and you've already seen it, they offer maybe free upgrades. They offer extra bedroom or extra bathroom, or little things to try to entice people, and that's the first thing they do. Then maybe they help a little bit on the mortgage, cut some closing costs. They're already doing that, and then eventually they just drop the price of the homes because they got to move it. So the fact that those home prices start dropping also means that even people sitting tight are going to see home prices drop, even though you're not selling. The other thing, housing needs low unemployment, and there's a very, very strong correlation here between the mortgage default rate and the unemployment rate. So with a low unemployment rate, you do see very few mortgages. So you're not going to see that 2006 crash when we got the point where we had high unemployment, and then you saw mortgages default like crazy. That's what spurred that on. A lot of people think it was the exotic loans. The exotic loans were definitely fuel to the fire, but it wasn't the fire. And I've been saying that for a long time. So right now we have low unemployment, but if we have a recession and unemployment goes up, defaults are going to come, especially when you factor in the fact that people are spending 45% of their income on the mortgage alone. If you lose a job, that's it. You can't do it. You can't pay that mortgage. It's also hitting in the apartment demand, so that we're starting to see that go negative the first time since 2009. So if you are a renter, you might be able to get lower cost or upgrade to something nicer if you'd like. I think that's going to start to happen, especially because a lot of the new construction coming onto the market is multifamily home. Now, I don't want to be totally negative on housing. There is one good thing, is there's a lot more equity in homes. People have more equity than they've had at any other time compared to the debt. So that's a good thing. So it does mean that, maybe if somebody does have a little bit of a problem, who knows, maybe they can access a home equity line. It would be a good idea for everybody to have a home equity line. I've always said that. Even if your home's paid for, you want to have that, because all of a sudden, even if you don't draw on it, but let's say, like I always use the example in New Orleans when Katrina hit, if you had a paid off house, and then they get flooded out, you may never ever get that rebuilt, or it may take forever, even if you have insurance. But if you had a equity line and you drew out 100, 150,000 in that house, all of a sudden the bank's going to be motivated to get this thing rebuilt for you. So it kind of puts them on your side, if you will. But there is access to some of this equity probably, and you want to do it before things get tough. If you go to the bank after you've lost a job, you're not going to get any equity. So have those things lined up and ready to go. So that could help stabilize the housing market for sure, unless prices start to come down quite a bit and that equity goes away. Okay, so that's all I've got today. And as usual, I'll throw a little disclaimer here. If you're not a client, don't take this as advice. Go see a financial planner. Okay, thank you so much, and we'll talk to you soon.